Howdy, Jacob here. Today we're looking at a Toronto company, Calibre Mining Corporation, 2 billion enterprise value, 1.8 billion market cap in the metals and mining industry. Doesn't look like they've been around for very long. It says they were incorporated in 1969, but I guess we don't have data prior to, at least revenue prior to 2019. So that's fairly interesting. Their return on invested capital does look pretty substantial of the last 4 years that they've made decent profits, and their operating margin and the 20 to 30% range is pretty solid considering their operating or their gross margin is less than 10% greater. So almost all their expenses are coming from cost of goods sold. They have very little sales, general, and admin and other expenses, to where they are flooding in a good amount of cash. They've been increasing shares a bit. We'll see whether that's through stock-based compensation or not. Okay, looks like they did just increase shares a little bit because their statement of cash flow doesn't look quite as good as their net income. And it's due to they do have quite a bit of depreciation and amortization, but their capital expenditures is growing very heavily. That could just be them reinvesting a good amount back into the business, which wouldn't necessarily be a bad thing, since the basis of capital expenditures is what it takes to keep the business afloat. But they also count factories, and in this case, maybe um, digging for or mining, going to a new mining location and spending a lot of money to get in that location. But then once you're actually digging or mining, it's pretty profitable past that. But that could be this capex. Again, we don't know until we look at that 10Q, 10K. But for initially, just based on the numbers, looks like they're reinvesting quite a bit. Their balance sheet has 116 million cash on hand. Not a lot of short-term debt or long-term debt. 14 million in long-term debt. So the balance sheet looks pretty attractive if this is all correct. And again, they're spending a lot on capex, which is dampening their free cash flow. So it's not looking as good as their net income, but honestly, not terrible. Not terrible with their return on invested capital being as high as it is to reinvest back into yourself. So let's make some assumptions here on the revenue growth side. The numbers, there's just not a lot of history. Maybe Quick FS isn't the best site to be looking at a Toronto company or a Canadian industry, but this is just what I'm used to, and I'm just not seeing a whole lot of data here. From a revenue growth perspective, I mean, maybe 10%. It's grown so much recently. I know metals and mining in the United States has definitely been growing heavily due to inflation being as high as it is, but I don't necessarily know too much about other things in the industry and Canadian economics specifically, but I assume that inflation is kind of occurring everywhere. So, revenue growth, I think 10% seems reasonable to me. They are in the metals and mining industry. What's the future growth? I don't know. Maybe it's a lot, maybe it's not. I don't think my perspective in 7 years is that there's going to be immense growth. I know that the earth is kind of limited. It's a finite resource. I'm not saying that necessarily gold, silver mining is finite. But I mean, I guess it is. So I think probably a little bit better than the market average, with margins of 15, and free cash flow is not quite as high, but they have been issuing shares a bit. I'll probably go in line with what they've issued shares with in the past. So maybe 5%. Maybe that's too high. Let's do 3%. Okay, so this might be a company I need to look at just because I don't understand it entirely from the numbers, and I could see how it could make sense. The 10% growth on a metals and mining industry is probably something that I'd be a little bit skeptical of. I'd really have to dig into the business and see whether they're going into new deposits and mining and mines that are really creating value and have a long time horizon of creating value, or else that 10% revenue growth seems a bit aspiring. And then the free cash flow margin being much lower than the earnings definitely does not make me very content. But honestly, it looks pretty interesting based on initial review. So I might try to do a deeper dive in this in a little bit. Hope you enjoy the video and have a great rest of your day. Thanks.